Hello and welcome to the Reorg, where we dive into the Satoshi Nakamoto Institute archives and re-examine old ideas after years of accumulated proof of work. This is your host, Michael Goldstein, also known as Bitstein, and joining me as always is my co-host, Pierre Rochard. Pierre, how are you this morning?
Very well. Thank you, Michael. How are you?
Good. It's another good day in America. And, Bitcoin in the here and now, Bitcoin is down from its peak, but I think I share your feeling where, it just gives us another 100K threshold to get excited about.
That's right.
So today we are continuing our journey through the S&I mempool crash course in Bitcoin political economy. And previously we were talking about basically why we think Bitcoin will continue to grow. And kind of on a similar note, we're going to be talking today about the article, How We Know Bitcoin Is Not a Bubble. This article was written in May 2014. So I believe that was a few months after the previous article. And the price at the time, so May 3rd, 2014, the price was $439. Previously, when we did, an article a few months previously, the price was more like $800. And I think that gives a good context to this article and the need to have written this article, which was the Bitcoin price had gone to over $1,000 for the first time in December 2013. And since then, it had been trending down. So obviously, it had dropped precipitously, more than 50% down to $439. And so there's a question, of course, is Bitcoin dead? And I didn't look up the, Bitcoin obituaries at the time, but, for early journalists and such that were paying attention at this time, there is sort of a field day to be had around, see, this thing is stupid. These internet nerds don't know what they're doing when it comes to money. And it's, laughs all around. But Daniel Krawisz wrote this article, How We Know Bitcoin Is Not a Bubble, which I guess, not only is it not a bubble, but it wasn't a bubble even just a few months earlier. And this article is trying to make sense of, what would make it a bubble and how can we look at Bitcoin and see that the price hype is something we can kind of look past. So with that in mind, let's get started. The value of money. No matter how many times Bitcoin grows by orders of magnitude, holdouts still remain who argue that it is a bubble destined to fail. To address this claim, I will describe a theory that describes how to appraise Bitcoin according to the Austrian theory of money. Just as a quick aside, Pierre, you're the finance guy. Can you define appraise in this context? Because it has a particular meaning aside, as we're going to see, from the concept of just, the price at a given moment.
Yeah, I mean, I think that it gets to the fundamentals. And so, for example, when you get an appraisal for real estate, there's a lot of different methodologies that they can have. The easiest is just you look at the comps, the comparables. So you look at, okay, what recently sold in the market, and how does it compare by square footage to what you're appraising? And so that way you can impute some kind of valuation based on the market activity. There's also this idea of looking at what's the utility of it, and more precisely perhaps, what are the future cash flows? What are the expected future cash flows? And I think that for a lot of investors, and this article will get to the heart of it, they say that there's no way to have a valuation of Bitcoin. There's no way to appraise its value and to know if it's overvalued or undervalued because it does not have any future cash flows. It doesn't generate revenues like a business does or like a real estate property does. So yeah, that's my short spiel on it.
Great. All right, continuing on. In Austrian economics, money is valuable because it is liquid. This means that a given value of money is demanded everywhere and can easily be traded for goods. For example, say I had enough bitcoins to buy a 100-ounce gold bar. In late 2010, this would have been worth around 1 to 2 million bitcoins and would have been impossible to sell on the open market without drastically affecting the price. By contrast, in early 2014, 100 ounces of gold was worth about 100 bitcoins, and this amount could easily have been traded quickly on one of the major exchanges without affecting the price noticeably. Thus, in early 2014, Bitcoin was more liquid than in late 2010 and was therefore a better currency. And I think this is a concept that's going to be important to keep in mind throughout the whole article. Unfortunately, this insight about the value of money does not give us a means of appraising it because the liquidity cannot be separated from the price. This is kind of a problem. It sounds like a circular argument because it says that Bitcoin's value is caused by its price. This allows no way to detect whether Bitcoin is overvalued or undervalued. In order to prevent this model from being causally circular, a time element is required. Our observations about money come from the past, whereas our judgments about its value are about the immediate future. This makes the value of money into a positive feedback loop. If the network is growing, then it will tend to continue to grow, whereas if it is shrinking, it will tend to continue to shrink. This model of money has no independent quantity that estimates anything like an underlying value. Any price is as good as any other. The only thing that matters is the direction it is moving. This is not really an appraisal after all, but it is still the right way to understand Bitcoin's price. Bubbles. In the short term, there is money to be made by buying anything whose price is showing an upward trend if one spots the trend early enough. In other words, if one can predict that other people are likely to appraise a good more highly in the future, regardless of whether that appraisal is rational or irrational, then it makes sense to buy into the change of sentiment. If lots of people begin to think this way, then they can create a positive feedback among one another and bid up the good beyond any rational appraisal of it. This is a bubble. A bubble bursts because eventually people have to get around to using a good for its ultimate purpose. Once it is understood that the people who actually use the good are being bid out of the market, then the price crashes because people stop predicting higher and higher appraisals to the price. Money, however, need not have any ultimate use. It may only ever be passed around from person to person without ever being consumed. A stock is valued by the sum of its interest-adjusted dividends. A bond is valued by its redemption value adjusted by the interest rate and the risk of default. A commodity is valued by the value of the goods it can be used to produce. However, for money, there is no independent quantity to provide a reality check. All money is like a bubble that never bursts. So, on this, I think one thing I want to note is when we even talk about bubbles, there's many things that happen. And we talked about this on a previous episode, but there is a difference from what is being described here, which is a sort of entrepreneurial bubble. There's something different there from a business cycle bubble, so to speak, where it is created because of systemic changes to the interest rate that causes a change in how everyone views the good in an artificial manner. So with an entrepreneurial bubble of this sort, this can happen on a free market, and it does. And it's about people having just over-exuberant expectations and so on and so forth.
Yeah, I think that's right. Basically, distilling it down to microeconomics of the price is greater than the fundamental value, and then that delta being the bubble, versus macroeconomic, a business cycle where that is happening at a systemic level of all prices are greater than the fundamental value of all assets due to manipulation of the money.
Yes. So this is making me wonder, and I wonder if you remember, when was the first reference to tulips that you recall in the Bitcoin space?
Oh, in the Bitcoin space?
Like against Bitcoiners.
Against Bitcoiners, yeah, I think it's basically like from inception. I'd have to go look at specifically, but I think that it's always been an immediate reaction from critics that it has no, let's quote unquote, intrinsic value, right? And so it lent itself to the idea of, from the first cycle, which I think was in 2011, where you really had a run up. That was probably something we can find on Bitcoin Talk forums of tulips.
Yes, and actually, that's something that I should have mentioned in the introduction when I was talking about the previous bubble. This was being written in the context. So we just came off the all-time high of $1,000 roughly, and previous to that, there had been a bubble at the beginning of 2013, late 2012, where the price had gone all the way up to $250. This was in that bubble was happening in the context of things like the Cyprus bail-ins that really made people concerned about the ways that governments were going to respond to various monetary crises. And there had also been previously the 2011 bubble, which was just with Mt. Gox. And that one was, there just really was an overexuberance in Bitcoin. And that went from, a dollar to $30 and then under $1. So it was a absolutely crazy bubble in terms of magnitude. And so this, in some sense, Bitcoin had been through, I would say, 3 major bubbles at this point, and it was coming down from the third, or price hype cycles. We're kind of talking about why it's not really a bubble in the way that people are thinking about it. So I shouldn't necessarily call it that, but
yeah. Although it does raise an interesting question of Daniel points out that it's basically what in finance they would call momentum. So it's 100% momentum. And I think that's there's that part of it from a price perspective where in the bear market, we have less Bitcoin adoption because the price is going down. And then in a bull market, we have more Bitcoin adoption because the price is going up. And then vice versa, right? It's the reflexivity of the price is going up because we have more adoption, and the price is going down because we have less adoption. So it's like a feedback loop in both directions that has caused Bitcoin to have these parabolic ups and then also the bad bear markets.
Yes. And there's actually, I think, a footnote that touches on this. So we might even have more to say on this soon. I'm going to continue on. So I'm going to get into Metcalfe's law. So some of the theory of money can be understood in terms of Metcalfe's law from computer networking. Metcalfe's law says that the value of a network is proportional to the square of the number of nodes. The rationale is that the network should be valued according to the number of connections it supports, which is approximately proportional to n squared for large N. Consequently, as the network grows, it presents a better and better opportunity for new members. As new members enter, the network improves for all its present members. Metcalfe's law must be adjusted slightly to apply to media of exchange because some of the nodes in the trade network will be more valuable than others. Those who have a lot of the medium are potentially able to spend more than those who have little. Therefore, use the market cap of the medium of exchange as N instead of the number of people. Similarly, some transactions are also worth more than others, so it makes sense to use the transaction volume rather than the number of transactions. A striking test of Metcalfe's law in Bitcoin recently appeared on the Bitcoin Talk forums created by Pierre R. I have created my own chart here. And in this chart, for those who are just listening, there is a plot of transactions excluding popular addresses squared. So that is in green, which will matter because he'll reference colors in the explanation. But this is basically saying take all of the transactions on the network, get rid of the ones that are using addresses that are very large addresses. So these often are exchange addresses. So it's not necessarily in a sense, it's referencing a lot of settlement of off-chain transactions, for instance. So this is trying to account for that. And for the purposes of this, Peter was, I guess, trying to get the more kind of organic on-chain Bitcoin transactions. And then a purple line represents the Bitcoin market cap, which aligns quite well with this very volatile amount of transactions. So it goes up and it comes down a little bit, but it's trending upward the whole time throughout these bubbles. These hype cycles on a log chart, and the market cap trends with it very nicely, which is very interesting. There's a lot of things we find in Bitcoin price and such that has a very exponential rate. So there's a lot of relationships we can see like this. And, with that in mind, I think, we don't really talk about Metcalfe's law as much anymore. And we'll get to a little bit of a further, critique of how to look at this. But I think the important thing for me, at least, when thinking about Metcalfe's law back in those days, was just a reminder of how Bitcoin is a network good. And network goods, there's a couple different models that people have as kind of a way to financially appraise, that the value of a network, but they all are greater than linear. And I think that was an important thing to understand, was that Bitcoin, because it's money and money is a network good, it is something that is going to be growing in a non-linear fashion. So, different theories are going to have different beliefs about, what we use as inputs to think about that, maybe what the actual rate of change is. So is it anywhere from n log n to n squared to 2 to the nth power? There's all sorts of possibilities. Metcalfe's law was one in particular that was easy to grasp. And so I think it held well as a meme for a while, even if it's not necessarily the best one, because it just helps understand that exponential growth, that nonlinear growth in Bitcoin, and thinking on those terms. So continuing, this chart plots the market cap in blue and the square of the transaction volume excluding popular addresses in green. The axis on the left is the price in dollars. Exactly as Metcalfe's law predicts, the transaction volume increases very neatly as the square root of the size of the network. The correspondence is beautiful. I wish I had thought to make it first. I would like, however, to criticize the interpretation of the diagram. On the original Bitcoin Talk thread, the green plot has been labeled as Metcalfe value, as if it is an appraisal of the Bitcoin that estimates what it could cost. This interpretation is incompatible with the theory of the value of money I presented above. In my theory, the value causes the transactions, whereas in the diagram, the transaction caused the value. However, it is only potential transactions that cause the value. Past transactions are of no value to anybody. The current size of the network and the consequent opportunities it is likely to provide tomorrow are what motivate people to buy and sell today. This may seem like hair splitting, but a confusion of cause and effect can have serious consequences. For example, many people believe that it is necessary to spend Bitcoins and increase the transaction volume in order to make Bitcoin more valuable. Of course, this is nonsense. All this does is fill up the network with transactions for things that nobody actually wanted. That does not present a good value for a newcomer, because he will want a network that presents him with real opportunities, not just ways of artificially increasing transaction volume. The more that the Bitcoin network is focused on artificially increasing the transaction volume to make it look good, the more it resembles a Ponzi scheme. Rather, to make the network more valuable, we should be hoarders. This is more likely to present newcomers with lots of potential uses for Bitcoin as a medium of exchange. And this one, this is a statement that it was an important idea then to think about where is the real value of money coming from, as a medium of exchange, and what that means. How does holding affect this? Why do people hold money, et cetera, et cetera? But funny enough, somewhat, I suppose, unfortunately, 11 years later, this sentiment is still very important.
Yeah, and like if you fail to take this paragraph seriously since it was written, you could end up on like a fork like Bcash or BSV, because fundamentally their ideology is the diametric opposite of this paragraph.
Yes, there's always like a need. We just need to see more transactions, and not looking at where's the real value. But I also think that there's people within Bitcoin today that still hold on to this. And the irony is people like us, I would generally put us in the bucket of, monetary maximalists. That's sort of, what got us into Bitcoin. That's how we're interpreting Bitcoin. That's not to say that there's absolutely no other way to think about Bitcoin that isn't useful, but that has been our main focus since day one. And with that comes an appreciation for number go up, as we're seeing in this article. There, as a Bitcoin that is more liquid is more useful than a Bitcoin that is less liquid. So number go up as a proxy for that increasing liquidity is a good thing. When you talk about number go up, people often look at that and say, you are just presenting Bitcoin as nothing more than a Ponzi scheme, because it's just you're just trying to get the next people in to pump your bags and so on and so forth, not understanding that actually it's more useful for those people to be involved in Bitcoin, at a later date when the price is higher than it was for them earlier. Obviously, if you do that, you don't necessarily get the gains involved. But in terms of being able to use Bitcoin as a medium of exchange, it is more useful. Whereas the people who say that, some of them come up with various schemes of, shall we say, products they can sell, pictures that are on the blockchain or, some other thing. And this is done in the name of things like adding more value to the network because you have more activity on the chain. This goes into a notion of a higher security budget, which is claimed to be necessary to keep the mining going, and so on and so forth. So we get accused of pumping it as a Ponzi, but I think this actually does a good job of showing kind of, maybe it's the other way around. Maybe, if you can understand money the way we do, you would see that a growing use of Bitcoin as a way to save for the future is a very rational and reasonable way for Bitcoin to be growing, whereas just trying to artificially pump in ways to have more activity on chain doesn't really help.
Yeah, and it's really nice now that with Lightning, people say, how do you know how many Lightning payments there are? Well, you don't really. Some people try to estimate it. And so because it's off chain, it's got better privacy. You don't know exactly how many payments are happening. And so there's less pressure of, we need to pump this vanity metric in order to attract investors, which is very, Silicon Valley kind of shady startup thinking.
Yeah, in which case the people who want to, use the Lightning Network, if you want to find out, if you want to increase the volume of the Lightning Network and the activity on it, the best way to do it is to come up with a business that supplies people with goods and services that are so valuable that they're willing to give up their sats. And if you do that, Bitcoin will come to you.
The business would have to be such that paying with Lightning is the best option, and that people. It's why create a business that has excellent goods and services that people want to buy, and then artificially restricting how people can pay for it? You're just cutting out your top line revenue. And so it really, people have to wrap their minds around the fact that this payments method is downstream of the store of value. And I think this is something that Parker Lewis has very well explained, is that if you want to have Bitcoin payments, you have a double coincidence of wants, where the person has Bitcoin and you want Bitcoin and they want your good or service. And so that way it's not like this kind of putting the cart before the horse. Oh, we have to do payments in order for the store of value to be useful.
Yes, and of course, at Parker Lewis, at Zapbright, they add a premium if you want to pay in fiat. That is an optional thing that you can do, and that's to show it's like actually when you're accepting fiat, there's a lot of extra fees and stuff that's very cumbersome, and so it costs a bit more. But also, at the same time, it's like, I'd be happy to accept fiat because I can go turn around and turn it into Bitcoin still. So I can increase my store of Bitcoin. And instead, I think where you're getting at, with some of the others is there are certain goods. I think digital goods tend to probably fit in this category more, but certain digital goods and services that Lightning actually does present a much better way to accept money altogether. I think just a simple example would be something like a VPN, where someone already wants some level of privacy with regards to the payment for the VPN, because you want to minimize, the sort of relationship with the VPN provider, since there is sort of the privacy issues with VPNs can also exist, where it's, you could have a honeypot situation. And so Lightning obviously adds like a certain thing. So a VPN company that accepts Lightning might see an increase in Lightning payments because it's an actually useful way to pay for it over all of the others. But regardless, that VPN company can accept whatever currency and go buy more Bitcoin. So continuing on, appraising Bitcoin. A real good can be valuable because of the ways that it can be consumed or because of the trades that can be made with it. Mises called these causes of value use value and exchange value. Gold, for example, can be money and used as components in electronics. Evaluating whether a good is a bubble or not requires taking both factors into account. It is not enough to observe that the price of a good is far greater than can be explained by its use value to conclude that it is a bubble. To put this another way, suppose gold was only used in electronics. If that were the case, its price should be expected to be much less than it is now. However, some people started holding gold for longer periods of time before producing anything with it. This would cause the price of gold to go up, which would therefore make gold less useful as an electronics component. However, it would also make gold more useful as a medium of exchange. If gold's improved exchange value was enough to induce more people to buy it despite its reduced use value, then the price of gold could sustainably continue upwards. Its price chart might look like a bubble, but without the expectation of an imminent crash. So this is important within the Austrian theory of money, is that what we're seeing is a growth in the in this example, a growth in the reservation demand for gold. And so when we look at the value of, or the demand for money, there's two sides of it. There's exchange demand and reservation demand. Exchange demand is the demand for just wanting to acquire any at all, even just, receiving a paycheck. If you live paycheck to paycheck, you're someone who you have exchange demand for the good, you get it, and then you allocate all of it to whatever consumer goods and other things you need for that pay period. Whereas if you are a saver, then you also have reservation demand, which means some portion of your total cash balance you decide you want to continue to hold in that pay period. You might add to it if you're a net saver, but you also might have savings and then do it paycheck to paycheck, and you have your savings and you continue to hold that, but the rest of the money that you receive is purely exchange demand, and you spend it on stuff. But those two sides of those two factors in the demand are very important. And what's being described there is, like I said, a growth in the exchange demand, the reservation demand, which is naturally going to have something more than just merely, being used in electronics components and such. It could be for speculating on the, future demand for, gold's use in those things. But we can also see how it starts to actually form as a real medium of exchange. This brings us to Bitcoin. To what extent is Bitcoin's price a rational appraisal or an investment bubble? The answer is easy, much easier than with a commodity like gold. Bitcoins have almost no use other than as a medium of exchange. Thus, the fact that Bitcoin has any price at all is evidence that there is a real network effect and that the cause of its price is its exchange value. With gold, one has to consider the interplay between its use and exchange value, but with Bitcoin, there is no such confusion. Any demand for Bitcoin at all is enough to enable it to function as a medium of exchange. If demand continues to grow, then it becomes a better medium of exchange. There is no end to this process because the primary value of Bitcoin is the network effect surrounding it, not any final productive use. Each step in Bitcoin's growth follows a similar pattern of investment in the coin, improving Bitcoin's liquidity, creating more opportunity for its use as a medium of exchange, followed by investment in Bitcoin's infrastructure, thus realizing those opportunities. Thus, Bitcoin is not a bubble, or at least the available evidence strongly suggests that it is not. Its growth is like a self-fulfilling prophecy. As more people believe in it as a medium of exchange and become willing to buy it, they create the very conditions required of it to make it more useful. I want to start with this section. You recently gave a talk entitled Gold is Beautiful, Bitcoin is Smart, and it sort of touches on Bitcoin's improvement over this and also lends itself into a question of like, how should we appraise Bitcoin? A lot of investors obviously have ways to appraise gold. So what is it? What should we use about Bitcoin to appraise it as not just gold, but better, in addition to what Daniel's saying?
Well, it's really about whether gold should have a monetary premium or not, and whether that's good for society or not. And so it gets down to, there's like this regulatory definition of what a commodity is, and people say Bitcoin's a commodity. Putting that aside, because I think that's false, a commodity is something that you want to have an abundance of. You want to drive the price of a commodity down to trending towards zero. And that was an argument that was had with the environmentalists of we want abundance in order to improve our standard of living. So gold improves our standard of living not by being used as a store of value, but rather being used as jewelry or as an industrial input for electronics, for example, or dentistry. And so we want the price of gold to go down relative to, our purchasing power, not to go up. So that's where, the valuation, the gold bugs will say, oh, it's good to have something that is both useful and a store of value. And from, an economic perspective, no, that's bad. You want to have something that, like Bitcoin, is useless in anything else other than store of value. That way you don't have a conflict between people who want to use Bitcoin as jewelry versus those who want to use it as a store of value.
Yeah, Mises, mentions this and says, the fact that people want, or the fact that, things like gold have an industrial use, that is a thing we put up with for the sake of money. At the time, that was sort of the best idea there was of how to, reform our monetary system, was to go back onto a gold standard. And, despite the industrial use, we should still want gold because it's better than the alternatives. But now, because Bitcoin exists, we have something that doesn't have that problem at all. And so in that sense, when those gold bugs are appraising the value of gold, it's almost like their appraisals of gold is just wrong, because they're not thinking clearly about what that monetary premium is, and they're only thinking about what it is at the bottom. So they're not really thinking about Bitcoin either as a medium of exchange. They're only looking at that. It's like, okay, there's like a sort of insurance, so to speak, where if everyone decides to use a different money, now you can, you still have something with your gold. But that doesn't really help you better understand, why is it that gold would be a medium of exchange? And, in today's world, it's like, well, why is it not a medium of exchange if it's, so great and being used in all of these, industrial components? And as we've said before, it's like, obviously legal tender laws and such play a role in the determination of what a market uses as money. But, the dollar remains a popular currency, despite the fact that it also has absolutely no kind of underlying use value in any sort of industrial sense.
Heard people suggest that you can use dollars as toilet paper, so there is some
wallpaper. Yeah, we can look at the Weimar Republic as a place to learn all of the great uses of paper after it's been demonetized. It's I guess that's I guess that's something you can hold on to your wallpaper. But I think that's interesting with Bitcoin, that like with many things, it abstracts it. It just gets rid of that underlying value altogether, so that we focus purely on how do we appraise a medium of exchange qua a medium of exchange, that is, like as a medium of exchange in particular, without even thinking about the other stuff, because the other stuff, it exists within the context when it needs to, like with gold, people still want gold jewelry and stuff, but it's not really playing a role in how much it's able to, increase the amount of monetary exchange in the marketplace. So there was a footnote in here, and this was getting to the hype cycle thing. So I want to go ahead and read that. This analysis leaves something to explain. If the value of a medium of exchange is just the market cap, why does Bitcoin go through hype cycles? Every time Bitcoin goes up in price, that is an increase in its underlying value. So why does its price ever crash? I don't know the answer, but I think I have a reasonable hypothesis. The network takes time to adjust to the enormous number of newcomers during each hype cycle. Each member of the network adds value, but this takes time. The members of the network must learn something about one another before the value they add to the network is more fully realized. If this effect is real, then the price could temporarily rise more rapidly than the growth that the network can support. And this goes back to sort of the community versus, the fundamentals and such. But I think I think there's more than just, getting to know one another. I think it's, getting to know the thing you're holding in the first place. If you are an investor who's just, you hear there's a momentum and a good, you hear a hot tip, and you go and you buy some Bitcoin, you're clearly going to be a much more sort of low information Bitcoin holder. And it's going to take time for you to think about what you're actually holding and make sense of it. So once again, there's a time dimension and a need to actually allow people to learn what's going on. And you can have a mix of that and just exuberance, because if money is a bubble that never bursts, if that's like one way that we can think about it, then in any case, any time that there is a price increase happening, you don't have an a priori knowledge that it must come down. If you go outside and you throw a ball up in the air, that, almost every single time, except for an infinitesimally small thing because of some weird quantum physics, thing, that ball is going to come back down. It's known what goes up must come down, as they say. However, with money, because it's this network good that actually becomes more useful with more liquidity, that bubble doesn't ever have to truly burst. There are limitations on that have to be overcome by the market in terms of, how much new money needs to be flowing into Bitcoin to be able to sustain a given price. And we might say that there is more or less likelihood of that new money actually entering the market, but we don't know ahead of time. So you could always think that actually this is the time, like Bitcoin is going to hyper Bitcoinize right now. And so people can get over exuberant just because there's the conditions are such that it's like, maybe this is the time. So there's a lot of different factors that can play into that. And those are all worth considering. Do you have any other, thoughts on kind of what drives these cycles?
Yeah, I mean, I think that it's interesting now that we're past the third halving, and that the question of what is going to be the cycle going forward is kind of top of mind for a lot of folks, because if we look at how this cycle has performed versus previous cycles, it has massively underperformed so far, and it's. Yeah, I guess I can't predict the future, but I also think that we're in kind of new territory as far as this question is concerned.
Yes, it's interesting how the price has underperformed in terms of magnitudes of growth after the halving, and yet we're also living at a time where it seems more bullish than ever in terms of the kinds of activity and talk and money flowing in and out of Bitcoin. It's a very exciting time. But perhaps that's also like our monkey brains aren't able to adjust that accordingly. Like it's hard to know the magnitude of a certain announcement here, like the Bitcoin strategic reserve in the United States in 2025. What would have been the equivalent announcement in 2014, and how to think about what that means in terms of the magnitude of growth. So a lot of this does remain a lot of TA and stuff, as they say. It's sort of like I'm trying horoscopes for men. I was missing the term there, but it's so we're kind of all just like feeling around, but yeah.
But it's also interesting the us recording this podcast and helping people understand the point made in this article, that education then increases their willingness or their marginal propensity to hold a balance, right? And the reservation demand of Bitcoin is also a function of the education of market participants.
Yes. So yeah, I mean, overall, I think this is an important article. One of my big takeaways with this is something I've thought for a while now, which is you get to call Bitcoin a bubble once. It goes up and it comes back down. Maybe we call that a bubble. When it continues to happen, that calls on us to try to have a better understanding of the fundamentals driving Bitcoin. And this was something that you were mentioning earlier. This article focuses more specifically on just the momentum side of things. But the important thing is there are underlying fundamentals that are sort of guiding that. And when you add those together, that forms kind of the basis for the long-term bullish expectations of Bitcoin.
Yeah, and now we can continue the discussion about how pejorative the word bubble is, because, and same thing with like the word speculation. People like to use
hoarding.
Yeah, or hoarding, and they use that as a pejorative. And the moment that you kind of just accept it and say, okay, it sounds bad, but it's actually good, that you enter a correct frame of mind that actually makes you a long-term hodler, and that you're not trying to time the market or figure things out like that, but that you have a much longer time horizon that, yeah, it's a bubble. Okay, so now we can move on to the next question of what is I like to call it the trough to trough, right? From the bottom of previous bear market to the bottom of this bear market, and drawing that line. I also saw that Adam Back, he likes to look at the 200-day moving average of Bitcoin. So kind of just smoothing it out to show, okay, aside from the oscillations of the Bitcoin price, can we get to a valuation that is a little more solid and based on the diamond hands, the people who really understand the asset, who understand what's driving the valuation, those are the long-term price supporters in a sense.
Yeah, and you mentioned 200-day moving average. I would go even farther. I like looking at the 200-week moving average. So that's basically a 4-year moving average, and that only goes up. And it's a very good one to look at. I like thinking of it as the sort of HODL price of Bitcoin, and whatever's above it, that's just like the trader price of Bitcoin, because they're going crazy, they're playing games with each other and so on and so forth. But that smooth long-term number is more just the HODL, this number go up, only up and forever, Laura. It's that sort of number. And you mentioned, the pejorative of speculative. I think that is highly tied to bubble talk because, in fact, most people say specifically speculative bubble. And in that case, I think it's important to understand is what does speculation even mean in the economic context? And people usually use that word just to mean it's like gambling, but it's not gambling. It's speculation is when you have, the expectation of a good having a certain price in the future, and you act as a market participant, taking an arbitrage on that and help that good get to that expected price in a more efficient manner. And as far as speculation, it can be bad if you speculate the wrong thing. So if you are trying to speculate on the Bitcoin price in, next week, that is a very difficult thing. And yeah, you're going to find yourself, getting a lot of whiplash and such. But then if you instead are thinking, how do I speculate on this over a long-term cycle, and you're looking at, the 200-week moving average, and I think if I had to guess right now, it's probably around $45,000 to $50,000. If your long-term thing is like, okay, in 5 years, do I think it's going to be higher or lower than 45 to 50,000? And if you buy according to that, you're probably it's not really, it doesn't. To me, I mean, obviously I'm biased towards Bitcoin, but it doesn't seem like as much of a just degen gambling. It's taking a very long-term view of okay, this thing has been growing. Why has it been growing? I think it's going to continue to grow. So I'm going to hold with an expectation of that long-term trend continuing. Whereas the people who then take the speculative bubble aspect, and it's they're thinking about the degens, just throwing money on a very short time horizon. Those people also tend to be effectively speculating that the price is going to zero, and that has not worked out for a single one of them. So yeah, they should probably learn to be better speculators themselves before, shaming Bitcoiners for trying to do, valuations of Bitcoin, especially when the long-term ones have been very correct and successful.
Yeah. It's like people trying to use a screwdriver on a nail, and then they're like, oh, this is the nail's fault.
Yeah. So, conclusion, Every time you buy Bitcoin, a fairy gets its wings. Now clap your hands, click your heels together 3 times, and believe in Bitcoin. It will only take faith the size of a mustard seed. So, that's the call to, think more about Bitcoin and just start actually taking it seriously. We would argue that if you started doing that, you're going to naturally start to see things more how we do. Do you have anything else to round that out before we close?
No, this was an excellent episode covering, I'd argue, one of the most important objections to Bitcoin.
Yes. All right. Well, thank you for joining us, Pierre. And to the rest of you, thank you for listening to The Reorg. This podcast is brought to you by the Satoshi Nakamoto Institute, dedicated to advancing and preserving Bitcoin knowledge. Our mission is to deepen understanding and appreciation of Bitcoin, not just for today, but for generations to come, by creating enduring educational resources and generational knowledge for generational wealth. If you enjoyed the show, please support our work by sharing links, deepening your own Bitcoin knowledge by exploring and studying the SNI archives, and contributing sats. As a 501c3 nonprofit, we rely entirely on supporters like you. Whether you can give a few Satoshis or a few thousand Bitcoins, your contributions enable us to continue educating current and future Bitcoiners worldwide. Help us fuel some speculative bubbles by giving us some sats we can work with so that we can help educate. Pierre, thank you so much, and I will talk to you next time.
Thank you, Michael. See you next time.